Welcome to this explainer. Today, we're unpacking the Growth Lab trading discipline, and we're going to figure out exactly why a high win rate doesn't magically translate into a growing portfolio. If you've been trading for a while, you already know the pain I'm talking about. Watching your overall balance just slowly bleed out over time, even though you feel like you're winning way more often than you're losing. It's frustrating, right? Well, today, we're going to look straight at the math, the psychology, and the hidden traps that create this exact scenario.
So let's dive right into this big question that frustrates so many of us who suffer from stagnant accounts or sudden blowups. Honestly, it's incredibly demoralizing. You spend hours researching, you execute what feels like a bulletproof strategy, you string together a bunch of small wins, and then boom, one terrible Tuesday wipes out your entire month of progress. The core problem here isn't the market, and honestly, it usually isn't even your underlying trade ideas. It is entirely about your behavior, your expectations, and how you manage the emotional extremes of trading.
Here's our roadmap for today's explainer. We're going to cover the secret strategy trap, the reality of profit, surviving the ordinary, pressing the exceptional, the 2% rule, and we'll wrap up with your trading homework. Let's get right into it.
All right, part 1, the secret strategy trap. Look, the crucial point here is that searching for this mythical holy grail strategy is a psychological trap, and it's actively keeping you unprofitable. We've all been there. You might think you just haven't found the right settings on your moving averages, or maybe you're just not following the right stock picking guru yet. But this relentless pursuit of a 90% win rate system just keeps you constantly jumping from strategy to strategy, because we all hold on to this completely unrealistic expectation of a smooth, uninterrupted upward line of profits. The very second you hit a normal period of flat performance or take a few minor losses, you abandon a perfectly good system because you assume it's broken.
And here is the real difference between retail and professional traders: forced accountability. Professional traders aren't somehow endowed with superhuman market-predicting abilities. They just have a strict risk manager, an employer who will literally fire them on the spot if they break the rules. That enforced discipline keeps them in the game. You, on the other hand, as a retail trader, have zero external oversight. So when you get mentally fatigued after a frustrating week of sideways chop, there is absolutely no boss standing over your shoulder stopping you from doubling your risk on a purely emotional whim.
Moving on to part 2. The reality of profit.
You simply have to forget the myth of the smooth upward graph. Actual, real-world profitable trading requires enduring long, incredibly boring periods of flat performance. If you were to look at the equity curve of a truly professional, highly profitable trader, it doesn't look like a rocket ship taking off. It looks like weeks, sometimes even months, of horizontal movement. It's a total slog. Small wins cancel out small losses, but then, punctuated along that flat line, are sudden, rare, massive jumps. That is the actual mathematical truth of trading. If you can't stomach those long flat periods, you will never be around to catch the massive jumps.
Which brings us nicely to part 3, surviving the ordinary.
Think about your trade distribution like this. A massive 80% of your trades are just ordinary noise. Meanwhile, only a tiny 10 to 15% slice actually makes your entire year. The crazy part? At the exact moment you enter a trade, you have absolutely zero idea if it's going to fall into that massive 80% bucket or that tiny golden slice. Because 80% of your trades will basically net out to zero over time, your primary job is simply surviving this ordinary majority. You're just building your daily muscle memory by taking standard, boring entries and exits without letting them emotionally derail you.
You really just have to survive the ordinary. Letting frustration push you to double your risk on a good feeling is a devastating mistake. Imagine you've been trading perfectly flat for 3 months. You're bored. You're frustrated. Then you hear a hot tip on financial TV or maybe from a buddy, and you decide, okay, this is the one. I'm going to size up to make back my time. That single deviation from your plan is what blows massive holes in your portfolio. Just one slip of discipline here, sizing up when you absolutely shouldn't, will completely undo an entire year's worth of careful, methodical work.
All right, part 4, pressing the exceptional.
Okay, we have all heard this famous piece of advice: you can't go broke taking profits. And naturally, your human instinct wants to agree with it. I get it. It feels incredibly satisfying to see green in your account, close the position, and lock it in safely. It gives your brain a quick, massive hit of dopamine. But listen closely. Taking early profits is arguably the most destructive piece of conventional wisdom in the entire trading world.
Let's explicitly reframe this. Exiting high-potential trades too early is actually a portfolio-killing mistake.
Why? Because doing the highly uncomfortable work of pressing a winner is required to drive your annual returns. Remember that distribution we just talked about? Only 10 to 15% of your trades are exceptional winners. If you take early profits on those rare trades, what on earth is going to pay for all your small losses and your long flat periods? Absolutely nothing. Your account will just bleed out. The profitable behavior here is emotionally agonizing. When a trade proves you right, you don't sell. You sit on the profit and you actually do the most uncomfortable thing imaginable. You add more exposure. You risk turning a winner back into a loser. It's terrifying for sure, but it is mathematically essential.
Let's put some real numbers to this to prove the point. In the Growth Lab Daily Play portfolio, a single trade on Alphabet accounted for nearly 25% of the total yearly gains, bringing in a massive $13,000 all on its own. How? Because as it proved itself correct, exposure was repeatedly added. Now contrast this with Broadcom. They applied the exact same strategy, added exposure to a winning setup, but the thesis eventually failed. And guess what happened? Because they managed their risk, it was just a normal loss. It didn't destroy the portfolio. You have to take those shots because you never know which one is going to be your next Alphabet.
So how do we protect ourselves? Part 5, the 2% rule.
If you take away just one single thing from this explainer today, let it be this massive 2%. I want it burned into your memory because it is your ultimate mathematical edge. It is the hard line between traders who survive to see long-term profitability and those who blow out their accounts and quit within their very first year.
This 2% rule ensures that even if a stock drops $50 out of nowhere after earnings, you never lose more than 2% of your account on that single event. Look, you're human, you are going to have bad ideas, you're going to get caught in unexpected market reversals, but if you relentlessly size your position so that the absolute maximum loss is capped at 2% of your total capital, no single disaster can take you out of the game. It completely, totally neutralizes the threat of an account blowup.
And please, use the right tools. Trying to calculate position sizes in your head while the market is moving super fast just leads to severe mental fatigue. When you get tired, you get frustrated, and when you are frustrated, you make terrible, impulsive decisions. By using a simple risk and investment calculator, you just input your account size, lock in that 2% risk, and the tool tells you exactly how many contracts or shares to buy. Boom, done. You preserve all your mental energy for managing the actual trade.
Okay, let's put it all together. Part 6, your trading homework.
I want you to actually go do this today. Pull your trade history and grab your last 20 to 30 trades to get a good sample size. Identify your top 3 winners. Now calculate exactly what percentage of your total profits came from just those top 3. When you do the math, I guarantee you are going to find that a massive percentage of your gross profit came from just those couple of positions. Seeing this with your own actual numbers proves everything we've talked about today. If you had cut those top 3 trades early to take profits, what would your account look like right now?
The math doesn't lie, and now you have the blueprint. Stop chasing the holy grail, survive the ordinary chop, using the 2% rule, and when you finally catch that rare winner, do the hardest thing in trading, press the accelerator. Thanks so much for joining me today. I'm going to leave you with this final thought to audit your own behavior. Are your top trades really driving your portfolio, or are you actively sabotaging your winners? Think about it. Stay disciplined out there.